Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets for regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon is Scott Nations, President of Nations Indexes, and Mark Sebastian, CEO of Option Pit. We're here to discuss what bond volatility may be signaling as it relates to how the VIX is acting and if that is election related. It is great to see the both of you as always. Welcome back to Trade Talks. And Mark, tell us what you see as it relates to bond volatility and how that's not necessarily jiving with how the VIX is acting. It feels as if perhaps volatility might be pushing a little bit farther than just the election results.
Yeah, I mean, we all know that the VIX has been elevated relative to how much we've been moving, and people have been saying, well, when the election happens, VIX will come off. VIX has historically always been a little bit bid ahead of election and then comes off afterwards. This seems like it's a little bit overdone relative to history, given to where the overall market is moving. And then I'm looking at the bond market, and the bond market is in a free fall. And let's pull up our chart. The implied vol, this is TLT, so it's the long bond, so it's 20-year duration. TLT vol, the cost to buy options is now higher than it was on August 5th when the world was panicking. We have to go back to October of 2023 when bonds were in a full-on free fall to find a period of time where TLT implied volatility was this high. And it makes me wonder whether, hey, is what we're seeing in the VIX all election related, or is there a second shoe to drop that the market is not looking at, something related to, maybe August 5th was just kind of a tremor before a major earthquake, maybe related to, nation's debt, if you will, or maybe, debt related, or somewhere in the bond market, because the treasury market is not behaving like the S&P 500 is at an all-time high, and that the Fed is entering a rate cutting cycle. So something is not jiving here within the overall bond market.
Right. And Scott, if we look at the equity side of the equation, volatility is higher and the market is continuing to make all-time highs. Granted, it's off a bit today, but for VIX to be where it is, considering how, the run that the market has had, it's a little bit concerning when you see both of them moving in tandem.
That's true. I think one of the reasons that equity implied volatility remains relatively high and very high for what you might expect with a stock market making new all-time highs, it is a hangover from what we saw in August when implied volatility really spiked. Now, Jill, you and I have talked about the fact that traders love to come in, love to rush in and sell implied volatility in a way that they never had when there was a big spike. But they've sold it off down. They've sold it off quite a bit. But I think that they're still worried. They're worried for several reasons. Mark touched on a couple of them. One is the election, and another is the fact that bond market's not behaving very well. Why isn't that happening? Or why is that happening? Well, I think people are starting to pay attention to the fact that our budget deficit is enormous. And that's not a political point of view. That's just a objective looking at history point of view. And an example is today with the 10-year yield up 10 full basis points. So I think all of those things leave equity implied volatility really high. And I also think that it's informing what we see in bond vol. And one thing I would leave you with is that in the bond volatility world, we're starting to see a fair amount of put skew. Normally, out of the money calls and out of the money puts in something like TLT trade relatively near parity. But now puts, which protect against downside, are trading a full third more expensive than calls, and that's pretty unusual.
Yeah. And I think it's smart for both of you to make that observation because, Mark, if I had to, gun to head, make a choice, what am I more concerned with? Fed interest rate policy relative to fiscal policy and the complete lack of discipline around that. I would say the latter is more concerning to me. It has far more reaching implications as far as I understand it than the marketing trying to interpret 25 basis points, 50 basis points. I realize that's more reflective of what's happening with the economy, but our fiscal policy or lack thereof, it's unsustainable. We're not we're not fixing the issues that exist, and we're just bringing more onto the debt. The music is going to stop at some point, and perhaps that's what you're seeing in the bond market, or why the VIX is elevated. And someone's not going to be left with a chair at the end of the day once this music stops.
Well, yeah, I mean, the bond vigilantes clearly are stepping in. If you look at both candidates, they're obviously both very inflationary, and neither of them are really talking about cutting the debt down. The MOVE index, the BAML MOVE index, is trading 123. Again, we haven't seen this kind of bid for vol since the bond market really took it out in the chin in October 2023. That was not a very good time for markets. And so far, markets have been able to ignore a major sell-off in the bond market, a really pretty decent one. We're back to July levels before we got that nice run-up into the Fed meeting. And now I'm wondering at what point does a leg down in the bond market start to wake up equity markets, and equity markets decide, hey, you know what, this is a problem, and we're probably a little overbid here, and you could see the equity markets take a little bit of a kneecap.
Yeah, Scott, why do you think we don't hear about this more? I feel like everything in financial media, and I get you're trying to cast a wide net for a broader audience, but this to me sounds a little bit more concerning than perhaps the way we digest equity volatility. And I guess it's by the dip mentality that's been around for so long. Is it maybe perhaps it's not appropriate to ignore what's happening in the bond market? It's an existential question. I guess there's no right answer, but this seems a bit more concerning to me than perhaps what the equity market is suggesting.
I think you're absolutely right, Jill. We're not paying much attention, but the magnitude of the problem now is so much bigger than it was, say, 5 years ago, that we should be paying attention to it. And why aren't we? Because we become, I guess, numb to the concept of budget deficits, and it gets demagogued, and it gets really geeky in a hurry, and it's just not very sexy. And I think instead people would rather pay attention to some of the sexy stories that are going on in the equity world, whether it's Elon Musk or NVIDIA or one of these other things, and not pay too much attention to the really geeky, really boring, yet you use the right word, existential issue of the federal budget deficit. $1.7 trillion a year now, and you used the right word as well earlier, unsustainable.
Scott, admittedly, I do not understand this side of the market as well as I do other areas. How will we know if and when that shoe would drop, as an example? Like what would happen in the bond market? We're like, okay, this is for real, and structurally we need to do some work here. What would that signal be?
It would be a really ugly auction, a really ugly treasury auction where yields end up being higher than expected, where the bid to cover is worse than expected, lower than expected, something like that. That's really a surprise. Well beyond a couple of standard deviations from what you would expect. That would probably be the wake-up call. That would be the wake-up call anyway for the capital markets.
Right. Does that mean that we're not seeing institutions come in to buy treasuries, and that signals that there's a lack of confidence?
It would indicate to me that they expect more downside, and there's no reason to pay X on Monday if you think you're going to be able to pay 95% of X on Friday.
Right. Mark, I'm sorry, go ahead.
Yeah, that would be the banks, sovereign wealth funds, other countries holding back on bidding for treasury auctions rather than engage in the auction process. And bid to cover is not being very good. Those auctions start going really poorly. That, as Scott said, that tells you that there could be a real problem in the bond market developing. And watch that yield curve. That yield curve starts to fluctuate, starts to really get inverted again. We're going to have, that's the bond market telling you there's some fireworks coming.
All right. Appreciate everyone's insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.